This is Mike Carr for Banyan Hill. Today I want to dig into a timely topic, the yield curve. An inverted yield curve is a sign a recession is coming. That's been demonstrated by economists working at the San Francisco branch of the Federal Reserve, and it's been confirmed by Nobel Prize-winning economist Paul Krugman. So it's important to understand the yield curve and what it means to your investments. But first, before we get started, don't forget to subscribe to my YouTube channel so you'll be notified when I post my next educational video. Thank you for joining me for a brief look at the yield curve. I want to talk about what it is and why it's important. So the yield curve shows the difference in interest rates as we move out in the time to maturity. The government, for example, and we could find a yield curve for corporate bonds, foreign bonds, any market we want, but let's focus on treasuries since that's the most common. The government issues treasuries in different amounts of maturity. So there can be a 4-week treasury bill or a 30-year treasury bond, and the government issues those along with various other time frames in between. And the curve shows us the maturities against the yield. So if we look closer, this is a normal yield curve. And what we see are yields on 3-month treasury bills are lower than on 30-year treasury bonds. The reason for that is simply there's more risk the further we go out. So there's more risk of inflation eating away at your capital. Because remember, no matter when the bond matures, you get your original capital back. So $1,000 30 years from now isn't going to have as much value as $1,000 30 days from now. And that's what the yield curve is capturing, just those differences. Now, there's 3 ways to describe the yield curve. The first is normal, which we just saw, where yields are rising. The second is flat, where yields on 30 years are close to the same on 30 days. And what that indicates is that there's a concern about the future. Now, a yield is actually the price of money. So if you are running a factory and you're looking at expanding, if you're looking at expanding your inventory, you're probably going to borrow short-term money because you're going to sell that inventory and pay that loan back quickly. If you're looking at building a factory, you're going to want to borrow long-term money since the payback on that investment is going to be long-term. So the yield curve captures demand for those different types of decisions. In a normal growing economy, we're going to see the yield higher on the long end. On an economy where things are becoming a little bit uncertain, that yield curve's going to flatten. And eventually it could invert. This will indicate that short-term rates are now higher than long-term rates. This is relatively rare, but what it shows is that investors don't really want to focus on the short term. They're looking past the short term because they feel there's a lot of uncertainty in the short term. They're seeing signs of recession. You're not seeing as much demand from manufacturers trying to boost inventory because they're just not seeing the potential sales in the short term. So this is what a pre-recession yield curve looks like. This is an inverted yield curve, and it generally shows that concerns about the near term are higher than concerns about the long term. And that's really all the yield curve is telling us. Now, traders watch this because there's a lot of information in it. When the curve inverts, we usually see a recession. And a popular one is the 10-2. That's the difference in yields between the 10-year and the 2-year. And generally, anything from 1 to 10 years is called a treasury note. Under a year is called a treasury bill. Beyond 10 years is called a treasury bond. So just the nomenclature there that it's a 10-year note. We also see traders look at the 5-3, the 21, and various others just because traders are always looking for an edge. Turns out they're looking at the yield curve for a valid reason. it does invert. This is the difference. And when it's red, it's negative. It's inverted. And what we're seeing is that it does tend to invert before a recession. The recession is noted by the gray bars on the chart. There can be multiple signals. There's variable lead time. But it's generally, when we see an inversion on the 10-2, a recession is going to happen at some point in the future. Now, I know that's almost a meaningless statement, but it means be alert, watch more sensitive indicators. Now, where we are right now is the 5-3 did invert, and the 5-3 tends to lead the 10-2 by a few months. So because the 5-3 inverted, we should expect the 10-2 to invert early in 2019. Now, recessions typically follow within a year, but that's an average. It could be as long as 3 years. It can be as short as 1 month. The stock market generally declines sharply when we're in a recession. On average, it's about a 40% bear market when we're in a recession. The last 2 recessions, we have seen declines of 50% or more. So it's very important to take notice when that yield curve inverts. Thanks for joining me for a look at the yield curve and why the yield curve matters to investors. As always, I would love to see your thoughts and questions on this topic, so be sure to comment below so I can follow up. I'll have more videos on important ideas for investors, so be sure to subscribe to my channel. And if you're interested in learning more about my strategies, just click on the link in the description below. Thank you for joining me.